Hi. Hi, everyone. Thanks so much for joining this historic day for financial markets. So we thought that we would do this market live because there have been some epic moves in markets. Now, they were down at one point at the open. They then switched higher. They then sold off again and the move was faded, and it's all about tariffs. So it's a one theme that is dominating global markets today. It's not just about equities. It's also about bonds, and there's a lot of movement in FX as well, which we will talk to you about. But I thought the title of this is, when will the market crash end? The answer is, of course, we don't know because we don't have a crystal ball. But it looked at one point like it could end today because there was a rumor going around that Donald Trump would pause his tariff plans globally, apart from China, for 90 days. Now, that caused stock markets to rally very sharply. The NASDAQ and the S&P 500 were up about 5%. That was essentially a 10% swing because they had been down about 5% when they opened. So there was this huge move in markets, and then that was reversed. Now, that was about the equivalent of about $8 trillion in market capital. So it is insane, the size of these moves. Now, I'd like to switch to looking at the charts because that's where all the fun is going. Now, this chart is an interesting one. That's not the one I wanted to start with, but we will start with this one, which is that World Equity Indices, just to show you, absolute sea of red. S&P 500 currently down. It's the the sixth column across from the left. Currently, it's down 1.75%. The NASDAQ is doing a lot better, only down by 0.64%. Now, that compares to declines of 13% for the Hang Seng over in Asia, nearly 8% decline for the Nikkei today, and about 4.5% declines, 4 to 5% declines essentially for European equities. As you can see, European equities and Asian equities, of course, closed. It's just the US that is moving higher. So very much another weak day, not as bad as what we saw on Thursday and Friday last week, but still lower. These moves, as I said, we've had massive volatility in financial markets. In fact, I'm going to show you that chart. This is the long-term, over 35-year chart for the VIX. So that is Wall Street's fear gauge. Now, if you look on the very right-hand side, that is where volatility is today, above 50, and it's climbing. If we look at the peak just before that, that was COVID. So that was 5 years. We've seen the biggest move in the VIX index since COVID. So one of the biggest moves in 35 years for volatility. So this just shows you the extent of these moves. We're in a headline-driven market. What is moving markets is what's going on with tariffs. When will they be reversed or paused, or some sort of change or moderation in the tariffs? That is what is driving markets at the moment. And today we've seen both upside and downside impacts of volatility, and that is playing havoc with financial markets, and lots of price movements. When volatility moves this high, remember, there's lots of opportunities in the market. Now, someone has said, how long will the crash last for? And I think that is something we're all asking ourselves. You tend to see that these points, just look at all these periods where volatility is shot higher. I do just want to draw your attention to the fact as well that volatility is currently higher than it was, if you follow my arrow here, than it was in the financial crisis. So this is crazy. Now, partly that's because in the intervening periods, decade or so, like 17 years, I guess, since the financial crisis, we've actually seen a lot more digitalization of trading, and that has made things, that just exacerbates the market move. So things are happening a lot faster, hence this rapid move higher in the VIX index is, even though it may not seem like things are necessarily as bad as the financial crisis, they could obviously go that way though. So let's take a look at where else we are. So how long will the crash last for? Typically what you see, sorry, I'll just go back to that VIX chart. You see volatility spikes higher and then it comes down again pretty quickly. Volatility remained high though in 2008, 2009. So just remember that. When volatility is at this very, very extended level, remember this is a level we haven't seen for many years, it does take a while to come down. So we wouldn't necessarily expect it to come down straight away, unless of course we do hear something from the White House, because that has got the power, clearly, because of what we saw today when markets rallied really strongly, to reverse all of this sell-off in financial markets and this draining of risk sentiment. So that's just something to watch there as well. Now, in terms of what sectors and stocks have suffered the biggest declines, I just want to show you some commodities. I know you guys love trading commodities. This is just today, this is today's move and year-to-date moves. Today's move in WTI, it's down 1.6%. It had been down a lot lower than that. Likewise with Brent, down 1.6% as well. At one point, it was well below $65 per barrel, trading around 63. Currently at $64.50 there for Brent, but it is still down 13% year-to-date, along with WTI, which is down nearly 15% year to date. So really moving into that bear market territory for oil. Now, I just want to draw your attention to gold. Just follow my arrow here. We've dropped below $3,000 per troy ounce. We're down $70 on the day, 2.33%. Still, we're still up 13% on the year. However, a really, really sharp move on the downside for gold. Partly that's because of the volatility. Partly that suggests market capitulation and just cross-asset selling. People are selling everything right now, and that is worth looking at. Now, the other thing I want to show you, this chart shows you the performance of the dollar against the G10 basket of currencies, so against its biggest trading partners. Massive reversal, actually. The only currency that is still higher versus the US dollar is the Swiss franc today. That was not the case earlier on. The Swiss franc was up about nearly 2%. It's currently only up 0.1%. Instead, we've seen a big reversal in the dollar. Pound is down 1.3%. The euro is down 0.5%. The Japanese yen as well, down 0.7%. Now, why is that? Let's just skirt over here to bond yields. This is the 10-year, looks at global bond yields, and it shows you the 10-year yield. If you follow where my arrow is in the change here, the change column, we've got an increase of 14 basis points for US 10-year yields, 16 basis points there for UK 10-year yields, and yields across America and across Europe, they're all moving higher. Now, why is this significant? This happened, and this shows you what could happen if Trump does reverse tariffs. Now, we've seen a big move to the downside on bond yields. If I just move this to 1 week, even with today's moves, we're still lower for bond yields. So down 6.7% in the last week on the 10-year in the US, 6 basis points in the 10-year in the UK, 12 basis points in the German 10-year. So we're still seeing weaker bond yields, but that prospect that tariffs could be paused has really caused a reversal in the bond market. Now, the bond market, worth noting, if you ever study fundamental analysis by John Murphy, he always says watch the bond market because it moves first and then everything else follows. So if the bond market is saying, well, is pricing out maybe some of the impact of tariffs and some of the need for central banks to come in and boost markets, then that essentially could mean that we'll see some sort of recovery. Now, it could also mean something else. I know this is really annoying, and it's annoying when kind of economists and analysts say things like this, but it's worth noting because it could also be a sign that the market is not expecting the Federal Reserve to rush to the rescue. If we just look at a WIRP chart here, now this is world interest rate probability for the US. I'm going to show you this chart. It looks really complicated, but don't worry, it's not. We have got a 47% chance of a cut in the next Fed meeting, which is in May, 88% chance of one in June, 91% chance of one in July, and a 70% chance of one in September. And we had been looking at the prospect of 4 rate cuts fully priced in for the Federal Reserve. That possibly is too much because there's a bit of a narrative that's coming up today about the fact the Federal Reserve will not step in to help markets. So this is way too much. There's been way too much priced in now for in the federal funds futures market, which is what this chart, this data is showing you. There's too much priced in. So that is why, if I go back to bond yields are rising because actually it's a sign that the market doesn't think, some people in the bond market don't think that the Federal Reserve will come in and cut interest rates. So that's something to watch, but it could also be a bit of a residual impact. There's no smoke without fire. It can't just be a rumor that he's going to pause these tariffs. That would be obviously the sensible thing to do. So we're seeing a reversal. So we've seen that reversal in stock markets. Although it's been faded, stocks are definitely having a better day, even though they are still lower than they did on Thursday and Friday in the US anyway. And again, bond yields, they had fallen really, really sharply Thursday and Friday. Now they're reversing a bit because they're a bit of a recalibration about what's going on. We also have if we're just looking at these bond yields, I'm just pointing out the pound there because the UK there, sorry, because the UK bond yields were much higher than elsewhere. And of course, whenever UK bond yields rise, we do tend to see the pound sell off, and that's what we've seen today. This is just a cable chart, so pound versus US dollar. As you can see, those blue candles on the right-hand side, that's down days. So we've seen a real sharp drop lower fell through the 200-day moving average at 128.13, and we're now down about 127.50 on cable, or just below that level, sorry. And that is about a 200-point move on the day. That's a huge move. So do watch that. Now, we're also looking at what stocks in the US are moving. Now, I'm using the US as an example. I will also look at the FTSE, although the FTSE is closed right now. But if we look at what stocks, this is just today's moves. We've seen some real big swings, both on the upside and the downside. Nike lower by over 5%. Black and Decker down by 5%. I think people think that no one's going to ride to the rescue of the housing market. And also Nike, of course, they do a lot of production in Vietnam. There had been hopes on Friday that there would be some sort of a resolution of the trade deal with Vietnam. That did not happen. So that's why Nike is falling as well today. On the upside, we've got Supermicro Computer up by 8.3%. A lot of people kind of piling in there because they're obviously filling their boots with Bitcoin now that it's on the downside. Dollar Tree as well. That's like a very kind of recession-proof company. And you've got some interest as well. Look at that, Broadcom, Hewlett-Packard. These tech companies are actually rising today. Now, if I just look at, I wanted to show you as well the Magnificent Seven chart. That is the Magnificent Seven. It had fallen to its lowest level since last May. This is a yearly chart, but if I look at in the intraday chart today, we have actually been moving higher. Sorry about that delay. We have moved higher on the Magnificent Seven. That's been led by a 1.5% increase in Nvidia. Remember, Nvidia sold off really sharply last week. It is now moving higher again. Now, if we look at the FTSE, what's moving, what's not, this is just today's move. So FTSE was down 4.8%, really led lower by a whole mix essentially, but pharma companies, you have companies that are, really leveraged to the global economy, like Reckitt Benckiser, the London Stock Exchange Group, because obviously stock markets are falling. Who's going to list anyway here? Sage does a lot of has a lot of trading relationships with the US as well. So really negative day for a big variety of sectors, but it's all the common theme is obviously tariffs, hence pharma being lower. On the upside, though, we only had very few, just 5 companies. So obviously Fresnillo, that is a minor, so that did a bit better. NatWest, a bank, and then Taylor Wimpey and Howden Joinery only just slightly higher, but by and large, a kind of a mixed day. We did see, it'll be interesting to see if US stock markets can hold on to those, like the weak, the much milder losses than we saw, and maybe that would help the FTSE to recover. Now, I just want to show you the DAX as well. Sorry about that. So we've got the DAX, and we've actually seen Commerzbank has managed to eke out a gain. So European banks, they were in quite a strong position. They continue to be leading the sell-off, though. It's the likes of Adidas. It's the likes of companies that had done really, really well for the rest of the year. Heidelberg Materials, Hannover Rück, which is a defense manufacturer in Germany, that was down 7.5% today. So all those companies, there's still a lot of good reasons to buy these companies, by the way, particularly in Germany. Remember, they've loosened their debt rules. They're going to be spending down the line later this year. So, on defense and on infrastructure. So, Heidelberg Materials, that could be a good opportunity. Hannover Rück, that's another one that's a good opportunity. Likewise, in the S&P 500, where do I think potentially the opportunities are for buying those stocks? It could be around banks, because banks, we've got JP Morgan reporting revenues for the first quarter on Friday. We've got Delta doing it on Wednesday. So they kick off Q1 earnings season in the US on Wednesday. They are expected to be slightly weaker than expected. That was slightly weaker than they had been before in Q4. But if we get, maybe a positive upside surprise, that could change the whole narrative. Likewise with Nvidia as well. Nvidia is rising today. Oh, sorry, JP Morgan first, and then I'll talk about Nvidia. JP Morgan, they are reporting results on Friday. The market is expecting 43 billion revenues for Q1. So, that's a hell of a lot of money. It's a real load of change there. So even though we're in this deep sell-off, it has only been 3 days of deep sell-off. A lot can happen in the next few days, and maybe we're making too much of this, and maybe we know that Trump has massively overreached in terms of his tariff policy. And if you can just moderate that somewhat, then maybe the effect on markets, maybe the effect on companies won't be as bad, and we'll be able to see a little bit of a turnaround. But I do think that, first in line for that turnaround could potentially be banks, particularly if they are delivering on the revenue side, because markets are still very jittery, so they want to see strong companies. Nvidia as well, as I said, it's higher along with the rest of the Magnificent Seven today. I just wanted to show you this financial analysis page for Nvidia, which just shows essentially the market is expecting revenue in Q1 of about $43.4 billion, and for the whole year, 204 billion for this current year, which is their 2026 fiscal year because of the way they report, and net income to be 111 billion. When we talk about these massive numbers, then that massive sell-off that we've seen in Nvidia, bear market territory for sure for those tech stocks, then it doesn't really it all add up. Something has to give, right? Either they have to start reporting massively weaker earnings to justify that valuation decline, or they, the market has maybe got it wrong and just gone too far on the downside. So there are opportunities there. I would think in banks, and I also think in tech, just because of the sheer size of their balance sheets, they could probably withstand any recession better than a lot of other companies. So those two are worth watching. Now, to finish off, guys, thank you so much for joining at this kind of last moment. But I just wanted to say, some tips on trading during these market volatile times. I'm just going to change that chart so that you can look at what equities are doing. And yeah, we've seen actually an even milder sell-off right now as we've just been talking. So there could be something coming out, something that's broken. So remember, markets are very much driven on headline news. When it's really volatile, it can be a bit very complex to trade markets, right? It's not necessarily complex to trade markets themselves, but it can lead to feelings of indecisiveness and things like that. Actually, in some cases, a lot of people, Warren Buffett for one, would be saying this is exactly the time you should be looking to buy, to make educated choices around buying equities because of better valuations. You don't want to buy when stocks are high. You actually want to buy when we've seen these capitulations, when the market's gone too far on the downside, which is what I think has probably happened, particularly if we do see something out of the White House, then we could see a big reversal in markets. I'm not saying they'll go back to the highs that they were at earlier this year, and those record highs that we saw in the NASDAQ and the S&P 500, but certainly the sell-off has been very, very brutal. So that is something to point out as well. The second thing is stay invested. Stocks historically have always gone higher. Yes, they have drawdowns. Yes, they have periods of market crashes, if you like, but they do tend to recover, and they're very, very good at recovering. And the third thing I wanted to say, there's awful headlines out there, and there's so much, the media is wall to wall with these negative stories about economic growth. Market sell-offs happen far more frequently. So bear markets, actually, so deep sell-offs in markets happen much more frequently than recessions. Recessions tend to be very rare occasions, but if you were obviously, this is kind of a man-made crisis because it's all linked to Donald Trump and his trade policy. If he can moderate that, then that could reduce the risk of a recession, because it's hard to see why the president of the US would want to decimate his own country's economy on the back of this. So it's only been 3 days, just remember that. A lot can happen in the next 3 days as well. So always looking at the bigger picture and zooming out rather than just zooming in when you're trading in these really volatile times. But without a doubt, there's a lot of volatility out there. There can be volatility on the downside. I expect there'll be volatility on the upside as well if we get a big market recovery. So that is something to remember. And I think that I've probably kept you all long enough, but thank you so much for joining. And we will be obviously, keep up to date, check our website, check out our alerts as well. And we've got you covered for this time in financial markets. So thanks for joining.